Welcome to the Roetzel HealthLaw HotSpot. HealthLaw HotSpot is a podcast for physicians and health professionals that covers the legal issues and trends that affect the healthcare industry.
Hi, everyone. Welcome to the HealthLaw HotSpot. Today, we're going to be talking about the exciting topic of how practices can be acquired by private equity. And we have a great guest with us as well. So let me make the introductions. First, I'm Ericka Adler. I run the HealthLaw Group, and I'm a shareholder at Roetzel and Andrus. I'm joined by David Hochman. He's also a shareholder at Roetzel and Andrus. He's part of the HealthLaw Group, and he's also the partner in charge of our Chicago office. And our very special guest today is Larry Elisco. He's a partner at Wipfli's healthcare practice, and he works closely with physician practices to provide accounting, audit, and valuation services. He has extensive experience serving the needs of physicians and their practices. Larry has specialized expertise in comprehensive financial reporting for physician practices, analyzing physician compensation and utilization, evaluating financial viability of ancillary services and equipment, and preparing practice valuations for sale, partner admittance, and marital dissolution proceedings. So that's a whole mouthful, but I know Larry, I know you very well, and we've worked together a lot on things that aren't even on that list. So I know that your experience is far broader than that. And today we're really excited because one of the things that you and I work together on is with many of our practices is, changes that happen out there, joint ventures, sales, mergers, acquisition. And one of the things we want to talk about today is really those practices that haven't been acquired yet, that might be thinking about it. And I talk to these practices all the time. Some of them just haven't been approached for whatever reason, haven't found the right partner. So one of the first things I want to kind of ask you about is, what do you do if you're out there, you want to be acquired, but nobody's made that offer yet? How can a practice or somebody working with a practice kind of make that connection to private equity to be acquired?
Sure. So I think that the private equity firms have a very strong appetite to deploy their funds, particularly on the healthcare side. So they are generally very interested in opportunities. I quite often meet private equity firms, and they have specialties that they're interested in. So if you're an ophthalmologist, or if you're in dermatology, or if you're an orthopedic practice, pain management, those are some pretty hot areas that private equity firms are interested in. And if you do have an interest, it's relatively easy to reach out to the private equity firms and get an introduction. I would suggest speaking to your lawyer or accountant first. They're typically, Ericka and I are typically pretty well tied in with many of these firms, and we can help make introductions, relatively quickly. There are brokers out there, and I use that term, they're advisors, they call themselves investment bankers, brokers, however you look at it, that will also make those introductions. In many cases, what they will do is charge you a retainer on a monthly basis, and then kind of work on your behalf to contact potential investors, as well as helping you put together information that the investor is going to need in order to receive an offer. And you can certainly go that route. I would generally talk to your accountant or lawyer first, particularly if they do have a healthcare background, because they're not going to necessarily charge a retainer. And the other part of it is that the brokers will often charge a percentage of the proceeds that you get from the sale. Right. They can range anywhere from 4 to 6%, maybe more, maybe less, depending on the nature of your practice. And while they do perform a very valuable function, I don't want to downplay the expertise they bring to the table. I would certainly talk to your professionals first, because again, these private equity firms have an appetite, and they, once they have the opportunity, they will work quickly, because they do want to deploy their money, and they want to build up the critical mass in their platform so that they can move forward with their plans.
Right.
Larry, let me ask you a question. If I'm thinking about looking to have my practice marketed to a private equity firm, what should I be doing before I approach the private equity firm?
Well, it depends on what they're going to be interested in. If it's what I've seen with most of the healthcare private equity firms, they will really just accept your tax returns and your internal financial statements, typically generated by, QuickBooks or one of your, whatever GL package you use, but they will accept that as the information that they need in order to get started. Then you'll work with your accountant typically to come up with a normalized version of your operating results over a period of time. And the private equity firm will use those operating results in order to value the practice and make an offer to you. Normalization means that, for example, if you're a very successful dermatologist and you're making $2 million a year in compensation through your practice, and the private equity firm would say, well, in order to hire someone to do what you do, we would have to pay, let's say, $800,000. There would be a normalization adjustment of $1.2 million to your operating results in order to come up with a valuation. So I'm using a somewhat of an exaggerated example, although, Ericka, I think we've worked on a deal where you've seen that, where there is a very significant disparity. And that those normalization adjustments are very important because that's what the private equity firm will use in order to determine your compensation on a going forward basis. So without getting too technical, the valuation of the practice will quite often depend on how you normalize those operating results. And then that determines how much you're going to receive as a result of the your sale.
Right. And I guess what I would say is a couple of things. One is that, these brokers, they can be helpful, but you still also have to pay your lawyer. So a lot of, some of these broker tend to try and take on a little bit of that lawyer role, whether they should or shouldn't. But I think it's very important that everybody kind of stays in their lane. So ultimately, you could end up paying both that broker as well as your lawyer. And so you want to kind of keep that in mind. But from getting ready to sell kind of perspective, I guess, what we should also mention, David, is that aside from the financial piece of it, to get your practice ready, you should also be taking a look a little bit about what you're doing. Those documents that you sign when you sell your practice have a ton of reps and warranties in it, right? So it's not about just how much money you're getting, but also that you have maintained appropriate financials over the year, that you've complied with the law, that you're not violating another contract by entering into an agreement to sell. We had a lawsuit that we helped with quite a while back, but there was a promise, not just a maybe one day, a promise to actually sell an ownership interest to a physician. And then the practice decided to sell. And the physician who had been promised that interest was able to get involved and get a piece of that purchase price. So that's just an example of knowing what's out there. What kind of contracts do you have? What kind of obligations? What kind of debt do you have as well? Maybe you can speak to that piece of it. Have you seen situations where people wanted to sell and just it was a disaster when you got right down to looking at the practice?
And yes, Ericka, thanks. And one of the things I'll add to that, and it's not because we're on a podcast with Ericka and David, but I always, first thing I will recommend to a client is that they consult with a healthcare attorney, because there are a number of pitfalls that go into selling a medical practice as compared to perhaps selling a manufacturing facility. So it's quite often the lawyers that are being used by the practice may not necessarily be healthcare attorneys. They just handle the routine corporate work. And when you're selling a practice, it's very important that you have a healthcare attorney that has regulatory and transactional experience. So I can't stress that enough. In regards to looking at the practice itself, quite often their books and records may not necessarily be in the best condition. If we're working with them, we hope that those records are in good shape. But quite often, you're working with practices that we're not necessarily involved with, and their books are not necessarily in order. In some cases, they may be, taking cash and not reporting it. Not that we would ever accept something like that, but that does happen, and that is a pitfall, where clients will be, or practices will believe that they should be, paid for something like that, and it creates issues. But quite often practices are on a cash method of accounting, and that's how they report on their tax returns, and that's typically what's being utilized by the PE firm in order to value the practice. In some cases, you'll see PE firms wanting an accrual method type of financial statement in order to move forward. Those are typically somewhat larger deals, but that can create some challenges, valuing receivables, coming up with, determining what the true liabilities are of the practice. So one of the things I always do is stay away from attesting to or giving any reps and warranties that the financial statements are prepared on a GAAP, generally accepted accounting principles basis. Even if it's on an accrual method, attesting that it's GAAP can create problems in with respect to what you're representing. But yes, and there are many times when the books are not in great shape, and there's a practice that's being acquired, and they can't reconcile their practice management system, which is what's used in order to schedule and bill and create accounts receivable. Those practice management systems are not integrated with the accounting system, and that makes for issues when you're trying to provide information to a PE firm. Quite often, there's another process called quality of earnings that goes into this, where the practice will hire a firm such as ourselves to really get in and understand and document how the earnings have been reported, and whether all the numbers make sense, and whether you can relate the collections to what is in the practice management system. And it's almost like a mini audit. So that quality of earnings becomes an important component of any sale that takes place, because that's really what the private equity firm ultimately relies on. That's typically something that takes place after a letter of intent has been executed and agreed upon, where the basic terms of the offer are agreed upon, and then the quality of earnings takes place after that. But that typically is where the rubber meets the road, and if the records are in good shape, it'll all be uncovered at that point.
Right. And, let's talk then about kind of the variations in how practices are getting valued. When it's a private equity coming in, I often see some very large multiples of EBITDA. I see some, tremendous offers that are being made, and, good for those practices. When we see hospitals acquiring practices, the numbers sometimes aren't as great. I hear, all kinds of fair market value arguments, like it's too much money, or we can't pay you for this, or we can't pay you for that. It's hard to know what to believe. And you can sometimes get multiple offers on the same practice that are completely different. So what kind of valuations are you seeing out there? Are some of them, not quite legitimate? What are your thoughts?
So the thing to, I think, understand is that how the private equity firm really makes money. The private equity firm will come in and offer a pretty strong, what I'll call a multiple, which is what's used to value the practice. It's a multiple of normalized earnings. And that multiple is what equates to the value that the owner of the practice receives. However, what the private equity firm will then do is, once they kind of assemble this critical mass of practices within their own specialty. So, for example, dermatology may be one of the focuses of a practice, and they may assemble, 5 to 10 practices. They'll pay a multiple of 5 or 6 of earnings in order to assemble those. And then once they have that critical mass, and once they may operate for a few years and show that they're profitable and they're able to increase profitability for a variety of reasons, then they'll sell to another larger private equity firm for a much higher multiple. And quite often the sellers will enjoy, some of that because they're going to have a certain level of stock that the private equity firm is invested in. And so, for example, they may sell for 6 and they may get a multiple of 10 when they ultimately sell to a bigger private equity firm. So that, is really the profit motive for the buyer. I think that when the valuations, often come in from a hospital perspective, they're a little bit more restricted because hospitals are really not allowed to buy referrals under, and I can, certainly Ericka and David can speak better to that than I could, but they are not allowed to buy referrals. So quite often the goodwill itself has to be valued. And it's kind of a difficult concept to understand, but when you have a private equity firm that's buying a practice, the assets are valued, and then whatever is the difference between the purchase price and the net fair market value of the assets, the difference becomes goodwill. Whereas with a hospital, the hospital cannot really do things that way because they're viewed as buying referrals by doing that, I believe. And again, you guys can speak to that. So they have to specifically identify goodwill when they buy a practice, and they'll do that by trying to value the workforce that's in place. What would it cost to assemble that type of workforce? They may value the charts. What does it cost to copy the charts? Things along those lines. And then they'll ascribe a value to the goodwill as a result of that. And as a result, you've got much lower values. And now sometimes hospitals will pay a signing bonus, a retention bonus. They'll try to get around that. But when you're looking at a value of a practice, private equity versus hospital, it's very difficult for the hospitals to compete. And that's what we really find. And we see, we actually are working on a deal now where there's a really significant difference between the private equity valuation and the hospital valuation. And it's because their hands are tied.
Right. And one thing I definitely see, obviously everybody selling kind of wants to get a big chunk of change in their pocket, and many of them do. But a lot of times we're seeing really the value to the selling physicians coming through a long-term employment arrangement where they're getting, let's say, a signing bonus, retention bonuses, a large guaranteed salary for some period of time. And we see these doctors getting locked in, 3 years, 4 years, 5 years. So they're not just getting the money and walking away. I rarely see that kind of situation. We see that more in the doctor-to-doctor kind of sales, obviously. And so, from your perspective, when you're talking with somebody about the sale and how much we want to kind of take a closing versus how good a deal we want through the compensation arrangement, and kind of what the pros and cons are, whether that's a tax issue or not, what kind of discussion are you having, and what kind of recommendations do you make in terms of where you prefer to see that money come in?
Well, if you're looking to compare being sold to a hospital, yes, versus a private equity firm, yes, I believe the hospital is going to structure an arrangement where the compensation is going to drive the value to the greatest extent that they can. Hospitals still, I believe, are required to meet fair market value standards when they pay their physicians. So they have to make sure that if they're paying a retention bonus or a signing bonus or something along those lines, they're not going to have issues with that. Private equity firm, on the other hand, will often value the practice based on the expected compensation arrangement with the physician. So in the first example I gave, where we said the physician was making $2 million and ultimately received, was determining the fair market value to be $800,000. That $800,000 is what they're going to get paid for the most part when they join the private equity firm's practice. And as a result, they are basically losing $1.2 million during that process. And they have to be comfortable that the money that they're getting up front, which for the most part will be taxed at capital gain rates, is going to make up for that. And it meets their plans. Quite often sellers may have a limited horizon that they want to continue practicing. They may say, yeah, I want to practice another 3 to 5 years. And if I'm getting a multiple of 6, that's probably a pretty good deal for me because I'm getting capital gains rates versus, ordinary income. And I'm kind of replacing my compensation with purchase price. And that's how the private equity firms are able to make money, by paying less to the doctor and then ultimately generating more on the bottom line as a result of that. So it is a give and take. I've seen a lot of younger practitioners that don't want to do that. They want to just continue on. And why, if I'm going to practice another 20 years, why would I take a big hit in my compensation just to get some money up front?
We see that dynamic in some group sales where the younger people are saying, well, I'm going to take, in your example, $1.2 million less. After 8 or 9 years, I will have basically lost the money I'm going to get on the buy-in or the buyout. So what's in it for me? I could have done the same thing and still been in practice for myself.
Right. There can definitely be a disconnect between different members of the group. And I think that's where, the business advisors come in terms of making sure everyone's on the same page. The last thing you want to do is kind of get far down the road only to find out that, one or more of the doctors in the group is not on board, because often that valuation and even the willingness to do the deal is tied to those doctors, those important, revenue producers all being part of the deal. So that's a really important upfront discussion to have. And hopefully, I like to emphasize spending a lot of time on the LOI. I think the rest of the documents can be more easily done later on. But that's really the time to start having those discussions and to go into much more detail than a lot of these LOIs do when they first come across your desk. Because the fact is, if we are not having a meeting of the minds, I want to find out now, because it gets more expensive and we're spending more time. And often you're choosing one offer over another. So the time to really have those discussions about the money, about the compensation, et cetera, is really early in the process.
I agree, Eric. I think that's very important, because I think that the theory is on one side or the other is let's get an LOI in place. It doesn't have to be so detailed. We'll work out the deals later on. And the more time and more effort people have invested in the deal, the more likely it is they're going to concede. And they may have a better bargaining position back at the beginning. And so this time in negotiating the LOI is critical.
Right.
I'm doing a deal right now where we have some terms we can't agree upon. And the idea is let's go ahead and do the documents and we'll figure this out later on. And, our advice to our client is that doesn't make any sense.
Right.
And quite often too, I think, and this is again where you guys come in, is that the governance issues become an issue, because physicians that are used to running their own practice and making their own decisions suddenly are under the direction and control of a larger organization, and they may not necessarily understand, what their rights are and what they are going to, be able to decide upon when they're running their practice. And I think the more that is spelled out in an LOI, the more you're going to be inclined to move forward or not.
Right. And, just to kind of wrap up this topic too, we're not really talking about employment agreements, but to that point, I think when I see these private equity deals falling apart, or when I say fall apart, I mean major regret on the part of the doctors who did the deal, is life after they get the paycheck and they sell the practice. Because, you have money in your bank, but you're miserable. And so focusing in the LOI and in the employment agreement about what is life going to be like? Where are you practicing? When? What is your schedule? What is your call? Can you be sent to multiple locations? Can they change your responsibilities? And, I know private equity acquisitions are really about the money, but from my perspective, we also really want to talk about, do you understand what's down the road? And I have so many doctors, particularly young ones, who who regret doing the deal after they've done it, or if they were, just part of a group that sold, maybe they didn't get part of that purchase price, but they get a new employment agreement and they hate it there afterwards. And so we see a practice that was doing really well starting to lose their doctors, and money aside, even if the owners got money in their pocket, it was never really their intent to have their practice fall apart like that. So I think, money is really an important part, but the culture and understanding all the components of a transaction like this is so important to our doctors. So, selling is not always what you think it's going to be.
I would also just throw in a caution about billing practices, and quite often when a practice is acquired, you may believe that your collections or your production is going to continue, but you have to really, I believe, do some due diligence on the billing practices and make sure that you're not going to be held to a higher standard, or things are going to be much more difficult to bill the way that you did before because you have a new billing service, or you may have an internal group that's a little more difficult. And I've seen that happen with practices where they believe their production is X and then suddenly it drops and their compensation drops accordingly. So that's important as well.
Right. It's a great point. I think you and I have worked on a case. 40% of collections or 50% of collections in one practice is not the same number in another practice.
Right.
So, and one of the things we try and do sometimes is make sure that they must maintain the historical collection rate or the same billing company or something like that. But, frankly, if you're selling out for several $1 million, you don't make those decisions anymore.
Right.
So we can only try and really kind of get a handle on that as best we can. But well, I think this has been great, and we've covered so much. I hope, Larry, you'll come back, and we'll talk about a related topic when we can spend more time on
Sure.
that.
You bet.
David, do you have any final comments on this topic for us?
No.
Well, I'm sorry, go ahead. Were you talking to me or? Sorry. Go ahead, David.
Go ahead, Larry.
No, sorry. No, I just think that the one thing to bear in mind too is that these can be very complex transactions. You would think that, oh, I'm selling my practice, here's a check, and here's some stock, but they can be very complex because of the physician ownership rules and the ability to defer your gain on any stock that you receive as part of this. But that's probably a discussion for another time. So I'm sorry to interrupt you, David.
So that was really the point I was going to make, that these transactions are often very complicated. There are healthcare regulatory issues, a lot of tax issues in many deals, and a lot of practical business considerations that if you've never done it before, they may not cross your mind. And I think having experienced advisors who've been there, done that is a plus.
Absolutely. All right. Well, great. Thank you. And hopefully if anybody has any questions, they can reach out to one of us. We're happy to answer those questions. We'll come back again with Larry at another time and maybe dig in a little bit deeper to some of these other transaction issues that we didn't get to today. But thanks so much for joining us, and we'll see you next time on the HealthLaw HotSpot.
Use of the Roetzel HealthLaw HotSpot does not create an attorney-client relationship between you and the firm or any of its attorneys. The Roetzel HealthLaw HotSpot should not be used as a substitute for competent legal advice, and you should contact an attorney in your state about any legal needs or questions you may have.